I never sell. I've collateralized it, and then I've used the collateral to go buy me my right side of my portfolio, which is the real estate side. So I know on my left side, if I sit and forget it and give it to my grandkids, it will have averaged out at 8% return like it did for the last 100 years, most likely, as long as the United States stays relevant in the geopolitical world. Yeah, maybe not, but worse things are going to happen if it's not anyway. But I know for a fact on my left side, it's streamlined. I'm not paying any attention. It's at this point, because I'm not trading in and out of it. It's not tax. There's no tax consequences at that point. But on my right side, I'm spending 99% of my time. That's my deals that I'm operating. That's my relationships that I'm cultivating. And that is everything that I can control.
Welcome back to the Real Estate Reserve Podcast. I'm Jason Dillon from Hard Money Bankers and co-founder Ian Horowitz from Equity Warehouse. If this is your first time tuning into the show, welcome. I promise we'll keep this entertaining and informative for you. Well worth your time. If you're a return viewer, follower, listener, watcher, thanks again for all the support. We certainly couldn't do it without you. We've got a great guest that we're going to bring in here that's just a little bit north on 95 from where Ian and I are located. So it's great to interview local guests to see what they're doing, especially in the Mid-Atlantic region, because, we interview a lot of different investors from all over the country, and real estate investing is regional, right? We all look at this kind of on a national basis, but it's very regional, and what's working in our local market may be very different than what's working in different markets throughout the country. So we're going to talk a little bit about his cash flowing portfolio and how he started, along with what he is currently focusing on and what type of assets him and his team are operating in today's market.
Yep. But before we do that, obviously, guys, a little bit of housekeeping. If you get any value out of this, we don't care about the likes or the subscribes or any of that. Let's just share the episode. That's the best compliment we can give our guests. If you get value out of this, or if you think someone would get value out of this, please feel free to share the show. And just as a side note, we're recording it sometime in July, and it is hot as hell out. So if we're sweating, it's because my office. If I'm sweating, it's because my office is not properly air conditioned. Not because I'm nervous about the guests, but enough about us. And let's bring Denis in.
Denis, how are you, man?
Hey guys, thank you so much for having me on.
Yeah, man. Yeah, I know you're just up the street. It can't be much cooler, even though you're a little bit north of us. So,
yeah, I feel bad. I got a hoodie on. I was in the cold plunge like an hour ago, so I'm still a little bit on the chilly side. But yeah, it's nice and 100 up in here too.
Yeah, I get it. What I guess, Denis, the best way, let's just jump right into it. If you just want to introduce yourself and kind of talk about how you got involved into real estate.
Yeah, so I started when I was 14. My oldest brother gave me a copy of Rich Dad, Poor Dad. I had a part-time job, so I did the only investment that I thought was accessible at the time. I was investing in mutual funds. Just to date myself a little bit, I actually bought stocks when you actually had to pay for trades. So it's been over 2 decades now. And I went to college. I went to New York City. I went to Baruch College. The goal was to go in and become the next Warren Buffett, do stock portfolio management. Went right into the global financial crisis. Couldn't find the job. Then got my MBA, and I started working for the government. And what I realized really quickly when I started getting my first real W-2 was that the government was not only my employer, they were my business partner because of the amount of taxes they were taking out. So I remember going home and searching, how do I pay less taxes? And the first page of results were probably illegal. So then I went back and was how do I pay less taxes legally? And then I got into a couple of bigger pockets, threads, and the whole 9 yards. But I followed up finding that I did want to invest in real estate with doing the stupidest thing possible. I called a family member and I was you invest in real estate, do you have anything you want to get rid of? And he looked at his crappiest asset, which was a low income housing property. I don't know if anybody who's familiar with it. It's East Orange in Jersey. It was a rough area. It's one of those areas that are always gentrifying, but never gentrifying. And I cut my teeth on that property. Ironically, it was Section 8. It was affordable housing, and I swore that day I would never want to do this in a larger scale, which is ironic because a decade later, that's mainly our focus. And but I had such a bad experience from that property. I started looking at more passive ways to invest. That got me into securities, and I did my first note investment, and then I did everything from ATM investing to life insurance investing, the whole 9 yards. Ended up actually writing a book about all my different experiences investing in these different LP deals. From there, I went on and I did an investment club with 2 other accredited investors. We started investing in every LP deal we found interesting. That got us tons of data of what deals actually work and what deals don't work. And then from there, we ended up launching a company, SIH Capital Group. And that's been our journey. I know it's weird to say in 30 seconds, but it was probably a 20-year journey to get to where we are now.
Yeah, let's talk about some of this cash flow and portfolio stuff, and then I definitely want to dig into the assets that you're operating, because I think hospitality and affordable housing is definitely interesting. So related to some of your cash flow and portfolios, I know you talked about alternative assets, ATMs, notes, life insurance policies. Like, let's just talk about the first one. Like, what was the first cash flowing asset that you invested in? How did you get started with it? How did you find the deal? Where did the capital come from? Was it your own capital? And kind of where is that today?
Yeah, so the first deal I ever did from a cash flow perspective was a note fund that I invested in. Ended up investing in that fund for 7 to 8 years, paid double digits returns, pretty consistent. They bought large portfolios of distressed mortgages. They rehabbed them, kind of flipped them on. They've actually, at this point now, are more institutional players, but we kind of jumped on pretty early with that. It was my own capital, and I think I heard the operator from like a podcast at that time, and I reached out. I like what they were doing, and so I ended up investing. At that time, it was 2014, I think. The investment minimums were a lot smaller for some of these private equity deals, especially with operators that were kind of just starting out, which made it more accessible for someone that was just kind of getting started in the investing landscape.
What type of returns back then were normal?
12
on a deal like that.
It was 12% for 3 years. And just to rewind a little bit, a lot of the reasons why I gravitated to an investment like that was because I was probably a decade in to my stock picking career at that point, and I started realizing after that decade that every income strategy in the stock world failed miserably. I went from MLPs, REITs to option trading, everything. Nothing worked as good as just having an index fund. And then an index fund is terrible for income. So when I started seeing hey, I'm not really going to outperform an index fund. Let me streamline that. But I need that cash flow. And then when I found this deal that did 12% with no volatility, no nothing, I was like, shit, this is perfect together when they work together. And that actually became the core philosophy for a lot of the stuff we ended up doing in the book that I ended up writing, is how traditional it actually complements alternative and vice versa.
Yeah, well, it gives you a good baseline to then compare against, right? And if some people use 8% as the target in the stock market or whatever number you want to use, your baseline, and hopefully you can outperform by doing something. My biggest problem with stocks is it's just not tactile. And I would ask you about this, going from investing in stocks, where my whole beef with it is I can't go find the CEO of Coca-Cola and bitch about something. But then you just want me to put money in, and you're buying a false piece of paper, versus guys like us who raise capital to do deals. And sometimes it's hey man, you're going to go put 25 grand in the stock market and you don't even know what's going to happen. You can at least call us. How did you combat that? Maybe internally, first off, investing money with someone else. And then how do you see it when people are investing with you and having that conversation around that topic?
Yeah, it's a funny topic because what I always say is well, you could network with CEOs, but you'll go to jail for insider trading, right?
Right.
Versus private investments, and we ended up monitoring, like a saying, we do relationship driven investments, because I feel like 99% of your returns are going to come from those key relationships that you develop, and it takes a shitload of time to develop those relationships. So what I just learned was that, yes, it is true, I am in the stock world. It is true, I'm parking my money with someone else that I have zero control in. And the only way that I've come to grips with that is because I know that there's a large chunk of my other portfolio that I do have a complete control over. So from a diversification purposes, it's pretty perfect. So like the way I describe it in my book is like, if you have a pie chart, I cut it in the middle, and on my left side is my traditional investments. Literally at this point, it's just an index fund. I spend maybe 6 minutes in a year on it. I never sell. I've collateralized it, and then I've used the collateral to go buy me my right side of my portfolio, which is the real estate side. So I know on my left side, if I sit and forget it and give it to my grandkids, it will have averaged out at 8% return, like it did for the last 100 years, most likely, as long as the United States stays relevant in the geopolitical world. Yeah, maybe not, but worse things are going to happen if it's not anyway. But
Yep.
I know for a fact on my left side, it's streamlined. I'm not paying any attention. It's at this point, because I'm not trading in and out of it. It's not tax. There's no tax consequences at that point. But on my right side, I'm spending 99% of my time. That's my deals that I'm operating. That's my relationships that I'm cultivating. And that is everything that I can control. And as long as I could come in with that picture, I could still do both, as long as I'm still comfortable with that fact.
Do you diversify personally at that kind of 50-50, or is it more like 80-20, active investments versus, full control investments, I should say?
Yeah, at this point, we transitioned out from the passive stuff more into the operational side. And as we keep progressing, it's going to be less and less. There's still some passive deals with some operators that I genuinely love. We also started a hard money lending division that we do, which is kind of a combination, like a hybrid of being passive and active. So we're going more and more towards the operational side. So the portfolio is changing over time into that. But because we don't sell our traditional portfolio, because we've collateralized it, the collateral grows over time. So it kind of keeps it in check. And then the key is to take that collateral and get it out of the stocks at that point and get into more of the alternative side.
Yeah, I'm gonna transition the conversation a little bit, because I think that makes a lot of sense, but it does relate. Like, and I think you're saying the same thing. Like, we have whole life insurance policies. You leverage against that, and that's a stable asset. And then you're going to deploy into new deals, and you pull margin against stocks to then go invest in new deals and hopefully outperform the returns. What do you believe for debt on your active? We'll use active as your real estate. We'll call that the active portfolio. What's your belief on debt and utilizing debt, and how do you guys view that as you're actively buying real estate, cash flowing assets to real estate assets?
Yeah. So with debt, I think there's a careful distinction between margin and collateral. Collateral, I love. Collateral is my favorite thing. Probably, like, besides my kids and my wife, collateral is my favorite thing in this world. Margin, I hate. So when I tell people, like, I collateralize my stock portfolio, they think I trade on margin, and I don't. Because when you collateralize, they will give you a checkbook for a percentage of your actual portfolio. Versus on margin, you are taking a loan out on the money that you don't have. So, for example, if you have $1 million in your stock portfolio, they'll give you a checkbook for $500,000. Now, unless there's a 50% correction, you're never really going to be called on it. So it's a pretty safe way of borrowing, investing, paying it back, and repeating the cycle and growing your assets over time. So that, in terms of that I'm completely fine with. And then even with individual deals, like going from buying an all cash deal versus buying a deal with maximum LTV, then at that point, that all becomes case by case specific on what makes sense. Our golden rule is, capital preservation comes first. So there's a way of doing it where you're not putting the investors' money in danger. It's fine. Like we've bought deals at 59% LTV, and then we've bought deals where we basically bought it all cash. So sometimes it's all deal specific. But if you're leveraging capital wisely and responsibly, I think the key word is responsibly, I think it's fine, and I think it's a great way to grow your portfolio.
So I think a lot of real estate investors, maybe not necessarily our ages, but older real estate investors, they go from fully operational businesses and investing and they're very hands-on and active early on, and then they transition into passive investing and cash flow investing. Not that you necessarily went the opposite way, but it seems like a lot of the cash flowing stuff in your portfolio, I'm guessing you're probably taking the proceeds from that and then putting them into your operational business and some of these growth assets. I guess first, is that a fair statement? And secondly, is it always just going to be growth? Or is it going to be like, hey, we made a killing on some of these assets. Let's go back into these income producing portfolios, either be an LP or just, again, like do private notes and things like that. That's kind of more hands off.
Yeah, I think it's a fair assessment. I think originally it wasn't as much strategy as it was just a place in my life. Like I was working a W-2. I worked for the government. I was working 60 to 70 hours. There was time to be an operator. And at that point, really being an LP was the only path. And there's nothing wrong with it. But once I got into the GP side, that kind of was like, I felt like the accountability and operational control was like a drug. Like you just want more of it. You don't want to, and you just see the results actually start magnifying pretty quickly. But there is a point, like we have a 5-year vision for our company. And by 2028, we want to have 8 affordable housing properties and we want to have 8 hospitality properties, because we know we want to keep a small team. We know that one of the biggest downfalls we've seen as an LP investment is when the team got operationally stretched. You saw diminishing returns. So our goal is to have like 16 ultra performing assets, and it'll provide more than enough for my family and my partner's families and everything like that. But at the same time, once that vision is reached, then there's going to be a point where we decide, do we want to expand our structure, operational structure, or at that point go back to the LP side of it and invest passively. But when we make that transition, I feel like that 10 years we've spent on the operational side will make us 100 times better LPs. Yeah. Because now I'm looking back at it, and some of the stuff I invested in 2007, 2018, I'm like, shit, I only got lucky because of the time, the fact that the interest rates went down. It wasn't because I invested with a good operator or whatever it is, blah, blah, blah. Now I know this. Now I feel like, I got an MBA course in LP investing. So I feel like I will one day go back to LP investing. And there's certain partnerships that we have, like in the mobile home park space, that we don't operate, that I will gladly put my money in going forward. It's just a matter of time and place of where I was.
Yeah, no, you have an opportunity to do some co-GPing, capital raising for other people. That's sometimes how Jason and I work. I do deals. I go to Jason and say, hey, how are we going to work this out? And he has a group of investors, whatever he does on his side, it's between him and his investor group, but he knows the returns that I'm providing to him. So I can see something like that. But I think I know what Jason was trying to ask. And maybe another way to ask it is like, how do you think about like storage of wealth, right? Because like you went from the stock market and let's just call it alternative investments to now active. And then it's like, man, at some point you're going to have windfalls. Do you just buy your own deal and then not have any capital investors on it? Like, where do you store wealth in the future? Like I bought a couple life insurance policies because I'm not putting money in the stock market. That's where I'm storing my wealth, because I understand that investment model. Like, I know you said 16 perfect assets, but at some point you're going to have more cash. Where do you put the more cash, right?
Yeah, so we do love life insurance policies. That is definitely like a big thing for us. We also provide, like, I feel like the LP world is a little flawed by kind of not thinking outside the box in a way. So one of the things that we're doing is, because we're doing fewer deals, we want to offer liquidity options for our investors. So if we're not doing 6 deals a year and a few investors want out every year, we want to be able to buy them out. So we want to buy out existing capital investors. I mean, that want to get out of a certain deal. So we want to kind of figure out how to actually make that standard in our deals. But yeah, no, there is definitely going to be a point. I actually think, we have a couple of deals that we bought in 2022 that now are in hold and wait till refi mode because there's tons of equity in there. So it's just going to be a matter of getting that equity out and then putting it into the next couple of deals. But yeah, between life insurance policies, between providing liquidity for other investors, and then honestly, like with alternative investments, there's a never-ending supply of interesting deals, from rare art to I just seen a presentation on whiskey investing. Like there's definitely no shortage of like where to actually invest surplus cash at that point.
And there also is, there's also not as much liquidity in the marketplace, for a lot of this stuff than someone might think. And I mean, no, I get it, because, you're also creating an investment vehicle for yourself with operating companies. And I do that. And you kind of mentioned that, with, if you're starting a hard money company, because like with our hard money company, there's the active side and the passive side. The passive side is me putting up my personal capital, my business partner putting up his personal capital, us putting up our business capital as a passive investor that's getting a predictable, easy rate of return. The active side is the investment vehicle finding deals day in, day out, which is not easy. And that's kind of where it's always been. And, and we're very, very passionate about the growth of the company, and we have been for the last 18 years of focusing on that. And I think that's the same thing. You have your operational company and you have the deployment vehicle where you're putting your own capital in. And Ian, we've chatted about this of, hey, as you're potentially unloading some of your big self-storage multifamily projects, it's, hey, where am I going to put the proceeds? It's like, all right, well, go buy a legacy asset that can do some great, provide great returns. Buy it in cash right now. Figure out if you want to leverage it up at a later date, if you need more liquidity. So I think we're kind of all on the same page with that. And, you hear the terms passive investing and then active investing, and someone typically thinks like, hey, well, wouldn't you start to be an active investor, growth, make money, and then invest in passive assets? And I think we're kind of all three, even though different types of paths and different assets, we all three kind of do the same thing. It's like, hey, we're very passionate about the companies and the assets we're operationally involved in every day. And that's just creating our own investment vehicle, right? That we can use to deploy our own cash and our family cash. Because let's be honest, like that's, there's probably nothing more rewarding than, investing your family's cash or friends and family's money into a high interest rate return onto an asset that you're controlling. Like there's a lot of satisfaction that we probably all get from that.
Yeah, and just one last note would be anything that I would want to store capital in, I just want to make sure it's collateralized. I know that word has been used frequently in this conversation, but like everything, like I went to that whiskey presentation where they syndicate whiskey barrels, and I'm like, well, can you collateralize that? That was like my number one thing. It's like, well, I'm not going to drink all of that, but can I collateralize it? Like, so those are the things that I think when you're storing wealth, when it comes to storing, just ask, because you'll be surprised at what you can collateralize.
Yeah, I think that makes sense. And by collateralization, then it allows you to have additional liquidity. Is that the reason you're looking at it that way?
Yeah. I want to always be able, that option of pulling that capital out to be using it to acquire other assets.
But still have that asset and not having to get bought out. And I think that's the connecting the dots for everybody that's listening is, when you collateralize it, you can go get a loan, buy something else, but still have that investment. And if you have a massive equity pop later, and if they go public or get bought by whoever, then boom, you win, right? Like, I think that's really, really smart. What, so like on your day to day, I know we've been bouncing all around. I started in Section 8, subsidized housing. That was where we cut our teeth. We're very far from that today. You're still in it. Are you doing single family houses? We doing LEIC projects? Like what are we doing on that end to do affordable housing?
Yeah, LIHTC at, I call it the Section 8 at scale type of situations. Just for the viewers who might not be familiar with LIHTC, the way I describe it is if you have a raw piece of land, the cost to build up that raw piece of land is surprisingly similar. Whether or not you're building Class A or you're building affordable housing, you got to run the foundation, you got to run the electric, the roofing, the windows, etc. What's different is the finishing touches, maybe larger floor plan, more open floor plan, etc. So the way that the government steers people into developing affordable versus just everybody just building Class A is these LIHTC credits. And these LIHTC credits usually come with 2 15-year restrictions. We usually buy in that second 15-year restriction because at that point, there's an end to the compliance period. We have the choice of bringing it to market, or we turn around and renew it for additional credits and additional funding and the whole 9 yards. But we love the space. The number one reason is because it actually has a barrier of entry. All multifamily across the board, whether or not, how many syndicators have gone to Texas, North Carolina, the Sun Belt in the last, 3-4 years. And I know you mentioned how Mid-Atlantic and region, and when people find out, well, I invest in Pennsylvania, I invest in Virginia, I invest in all the areas that the hot, syndicators are nowhere to be found. I love it. It's less barrier of entry, less BS. You're buying deals with less competitions. Like how could you go wrong? There's millions of ways of going wrong, but it just puts you in a better foot than a lot of other deals that I see out there, like that traditional value add where, you renovate a kitchen and you charge $400 more a month in rent type of thing.
Right. So you're coming up out of the ground with them, or you're buying them after somebody's already developed them?
We buy them in the second 15-year period. So usually the developer will build them. They'll hold it for the first 15 years because there's tons of incentives and credits. By that second 15-year period, all those incentives usually have burned off, and that's when they're looking to sell. And the beautiful part of it is a lot of these developers are incredible developers, but because of the restrictions through the LIHTC funding, it's really hard to pull a lot of profit out of some of these buildings. So when we come in and we pay off that loan and take it out, we don't have the same restrictions. So we'll commonly come into a property where it's 98% operating expenses, and it's 98% operating expenses just because they really can't pull profits out. So a lot of times they'll start their own property management company and they'll double charge for the property management. Like you'll see that all the time in the industry. Like you come in and you just charge normal. We have our own management company, so we'll come in and we'll charge the regular industry standard. And all of a sudden now your operating expenses just decreased by 10%. So you got like a whole bunch of these kind of things that you see with these developers who are really great at making a great community, townhouse community. Like if you drive into one of our properties, there's no way you would even think that it's Section 8. But at the same time, there's just so much operational efficiencies that you can institute day one. We just love the space.
Yeah, I think that it makes a lot of sense. And you don't have to worry about monetizing the tax credits, getting paid, and all that other crap, because that's always why I steered away from it, because I've always looked at it from the front side. And it's like, who wants to get in trying to sell those off and make your money back and do this and do that? It's just like, it's a lot. But yeah, the same sense is some of these buildings could be in a transitional area that, that burns off. And at the end of your 15-year period, you could turn it back into just regular old housing and you might have a massive upside.
Yeah. And, a lot of people take it from that viewpoint, but there's an actual interesting other viewpoint that I only realized after being in the space for a few years, is that the way that the HUD determines the different pricing for these affordable housing units is based on MSAs. So we're in a situation in PA where the local MSA to our property, we have 2 properties in Oxford, PA. I'm sure you're probably familiar with that is. It's an hour outside of Philadelphia, but Philadelphia is the closest MSA, and Oxford is a small town. Like the Hearst Potato Chip Company is from there. It's definitely a secondary or tertiary market. It used to be a big train stop between Baltimore and Philadelphia. That's what it was like famous for. And it's landlocked. So all around it is Amish country. So you have this little town that has had this population of like 5,000 people for the last like 100 years because it's landlocked, stable, not decreasing. It's not a dying town, nothing like that. And we're turning around and we're getting the same pricing for a 2 and 3 bedroom as if we were in Philadelphia, because that's the closest MSA. I call it small market rent arbitrage, and you're not going to find that anywhere else except for the affordable housing space.
Yeah, that's actually interesting. I lived about 15 minutes on the other side of that in Maryland, and we would go up to Oxford all the time to the what was that creamery? What's the name of that creamery? It's right across from the Hers place. Anyway, I know exactly what you're talking about, but it's actually interesting you talk about that rent arbitrage of you're utilizing a market, and then you went to the furthest ring humanly possible and said, okay, well, if I plant a flag here, I'm going to get better rent than everybody else. Very, very interesting. But now real quick, from the affordable housing standpoint, most of the tenant base in these apartment buildings or housing developments, whatever they are receiving a voucher. You're doing the RFTAs, you're doing annual inspections, you're doing all that fun stuff too, right?
So yes and no. So you're like 99% correct, but not every tenant has a voucher. That's where the common misconception is, because they think it's literally Section 8. It's not. So the actual restrictions is an AMI restriction, an area medium income restriction. It's not a voucher restriction. So what ends up happening is, depending on the original LEIC credit, ours in one of our Oxford properties is a 50 to 60. That means half of our residents have to be a 50% AMI, half of it have to be a 60% AMI. Now, we don't have to put in people with Section 8. We could just put in people at that area medium income. So it's interesting because Oxford itself has an income of 35 to 40,000, which is perfect for these type of properties, because as long as you earn, $30,000-$40,000, you qualify for these apartments. Now, outside of Oxford is Chester County, which has area median income of $80,000 to $100,000. So we sometimes pull residents from there, whatever it is. So it's perfect for what we do. Now, we don't have to take in a voucher, but we have to make sure that balance of 50 to 60% AMI stays whole. So we can't put in 30 doctors and lawyers in there, but we could put, the middle class, whatever it is. Now, if they have a voucher, that we can accept that, but we don't have to. Now, the interesting part about these larger affordable housing communities is sometimes we get what's called project-based vouchers. And this is like the holy grail of affordable housing investing, because project-based vouchers actually stay with the property. So what ends up happening is you get a tenant who, let's say, makes 35, 40,000, and now you could put them in a project-based voucher, and now all of a sudden they'll start getting rent assistance, even though they themselves don't have Section 8. And now if they're a bad tenant, like if you do a lease violation for them and they leave, now they know they're actually leaving and they're losing a voucher. So it's one of the rare situations that you have considerable leverage over your tenant. So you get a higher quality type of tenant. So it's an interesting, so we, in our property, out of like 50 units, 12 are project-based vouchers, 18 are tenant-based vouchers, and then the rest are regular, they call them tax credit union, but the only requirement there is that they only make 50 or 60% of the AMI. And then like one of our business plan goals for that property is slowly over time convert more and more units to project-based vouchers, which we expect probably in the next 5 years to have all 50 of them all project-based vouchers.
Yeah, that's you're right. It is the holy grail. That is it's what I did on a much higher level, but it's very smart, and again, like you said, the barrier to entry to get in is really the difficult part, and most people don't want to tackle that. They don't want to do that headache and understand the legwork, because it's not rent control, right? Like that's the other side of this, because if you look at some old ones, they're like, oh well, the rent's always got to stay X, versus this one's more based on what people earn, so you can still control the rent amounts, which I think is important in the overall project here.
Correct. It's definitely not rent control. And like we've increased our rents on, so one property, when I was talking about like the developers are great developers, sometimes they're not great operators. Well, we bought the Oxford property, rents weren't increased for 3 years. Their occupancy was great, but they didn't increase for 3 years. So what ended up happening is they were like $300 to $400 less than HUD rates. And we literally went there day one, and we raised the rent $300 to $400 just by submitting paperwork, not renovating units, not doing anything. It was literally just filing the necessary paperwork. And the majority of that $300 to $400 came from the housing authority, not from the actual tenants. So it was just because that developer had such a low cost of capital. He didn't care, but they didn't care. It was just poor oversight. But we care going in day one. So a lot of times you can get those $300 to $500 rent bumps. So we literally came in there. I think our average rent was $900 for a 2-bedroom. I think we're up to like $1,400 now for a 2-bedroom in that area, because that's what the Philly MSA dictates.
Yeah. Freddie, who's your financing? Conventional or?
No, we do Freddie. We only do agency for the affordable housing. They actually, what I learned in the process is Fannie and Freddie actually have a mandate, an affordable housing mandate. That's part of their, their core tendencies that they have to like follow by. So you actually get expedited processing. So if 2 mortgages come in the queue at the exact same time and one is affordable, the affordable by regulations is supposed to be taken first and moved through the process quicker. We also get like additional reductions where, the spread, let's say, is 2 points above the 5. Will come in and they'll give us a point, they'll give us a quarter off because we are affordable. So there's just so many little like nuances that really stack the deck, as long as you're willing to deal with the bureaucracy of, dealing with the housing authorities. It's not always great. Like sometimes they just say, oh, that is what it is. And you're like, I don't get it, but you have to just go through it. But it keeps so many other syndicators out of the space.
Yeah, no, dude, you hit the niche, right? Like that's what it's all about. You got your niche, you do your thing, you're the expert in it, and off you go. But then I would challenge you, like, why waste your time at the hospitality, or is there another niche that matches to this to allow you to do it, right? Like, is there synergies here that I'm missing?
No, so synergies between the two. Like I previously said, like we, like SIH Capital Group, we really are the relationship driven. We got into affordable housing side because of the partners that we had in that space. And those partners have nothing to do with the hospitality side. So we kind of roll like equity partners. So we have equity partners on the affordable side, and then we have equity partners on the hospitality side. And it was just a different partnership. The person that we partnered with on the hospitality side, he was a brand guy. Like he runs 15 farmers markets in New Jersey, which is like a very unique real estate play that I never even realized. So a lot of times with these farmers markets, you rent, let's say the parking lot, and then you subdivide it to these different vendors. But the trick is to create that brand to brand so you can market the small vendors that are going to be there. And that's what he was really, really good at. And he actually brought me our first hospitality portfolio. And then the success of that deal then people started bringing us more deals, and all of a sudden we had a hospitality division that it wasn't like 5 years ago. There's absolutely no chance that this is what I would be saying that we're doing today, but we have these strategic partnerships. It's growing. People are bringing us these hotel deals now, all of a sudden, blah, blah, blah. So it's just lining up in that way. And it's been working really, really well. The other big thing is I live in Freehold, and it's 25 minutes to the shore from where we're at. So a lot of times these hospitality plays are on the shore, and there's just something about investing. Like when I go to Oxford, it's a 2-hour drive. When I go to Ohio, it's a 7-hour drive. Virginia is a 7-hour drive. There's something special about like, hey, so I need to be on site, and I get in the car and I'm 25 minutes away from there. And then the last thing about hospitality is those rates that you're getting on the shore, we sometimes get more in one night at some of our places than we get a month in our affordable housing place. There's a festival in Asbury Park, See Here Now. We usually get booked out by March for our entire complex, which is 9 different bungalows. And that averages out to be like $1,500 a night for those nights. And that is more than what we get on some of the affordable housing side. So they complement each other surprisingly well, but there's zero synergies from those.
Yeah. So on some of this hospitality stuff, it's not just traditional hotels, motels. It's, whatever, a piece of land that has, like you said, whatever, 20 cottages on it, or things like that, and then they're got it.
A lot of it's just repurposing and figuring out what is the best use for that property. Like for the bungalow situation that we had, a lot of it was, hey, if the hospitality side doesn't work out, what do we do? Do we have annual rentals? Okay, great. If that doesn't work out, what do we do? Can we condo them out? So a lot of times with hospitality, it's about backup plans and brand building, because you could always get regulated out on the hospitality side. There's always something can go wrong. There's also a lot of politics that I was surprised with. We have a pipeline right now of 3 different properties, and 2 of them are going through variance processes, which we would never have with the affordable housing side. Affordable housing side, we buy, we operate as is. Our business plan is catered to the current use of the property, versus hospitality. We're coming in and we're usually changing the use of that property.
Are you guys internally managing that stuff?
Yeah. So what we ended up doing out of necessity is creating 2 different property management companies. So we have a property management company that exclusively focuses on the affordable housing side. That's called Affordable Housing Redefined. And then we have in-place management, which exclusively manages the hotel side of things. And that one we're pretty excited about, because we're reaching the point of acquisitions where we could actually bring in event planner and a PR person. Those are things that we need a certain revenue number to hit, that we've been kind of shoestringing. But when that happens, I think our revenue is going to really fly off for the hospitality side.
Yeah, I think there's something about that. I don't even want to call it high end, but like I forget where I was where were we? And I was just like, man, it'd be nice, like if I could just show up and it's like, hey, here's all the meals, or like we're gonna have stuff, like it's just done for you, like I'm not saying I live like that lavishly, but sometimes I'm like, man, it'd be nice if like all the bikes were here when I showed up, and the food, and like it's just done, and then you can actually go on vacation. So I heard a podcast somewhere else, someone was doing that down in the Outer Banks, just like, you want to do your trips, you show up, you want to paddleboard, we'll set it up, you want to fish, we'll set it up, it's done, and you don't have to think about it. And I think you're onto something with the party planner and going that way. I'll be interested to watch how that goes, except that part of the Jersey Shore is a little far north for me. That's where all the fist bumping is, isn't it?
No. The funny part is I come from like all my childhood friends love that whole fist pumping environment, and I couldn't stand it. Like I was the old man. I just want to read, hang out with my girlfriend. That's it. I don't need any of that. And then when I moved to Freehold, it took me like 2 years to realize I was actually on the outer circle of the shore. And then me and my wife started going to like Asbury Park for the restaurants, and Bradley Beach and Avon and a lot of these places like Spring Lake. And it's like, no, this is a very, very different, it's a different environment. Great capital raising environment, because those houses are $1 million to $2 million worth. So it's a great place to network. And the other thing is, like, when we're with the hotel, the resort side of things, and this is something I learned from someone I invested with, Josh McCallum does this really good at Accountable Equity. Once you have a resort, you have the ultimate capital raising environment. So in May, we did a retreat. We did a 3-day retreat where every bungalow was occupied by 2 or 3 investors. Some of them didn't even know each other, whatever it is. And we had a couple of guest speakers come and talk and the whole 9 yards, and we provided the food and everything. But the whole complex, all 9 bungalows, you walk outside, you're talking to another investor. And like, I would never in a million years put that together if it wasn't on one of our properties. So it just provides these great opportunities to do things. I always tell my hospitality partnership team, basically, like, the deals I want to do with you, I want to be out of the box, challenging me creatively. Like, and then my affordable housing guys, the deals I do with you, I want it to be the simplest cookie cutter deals imaginable. It'll be like, hey, what are we renting our raise? How are we cutting the expenses down here? And then on the hospitality side, it's like, all right, how can we create these different revenue models? Like, we're looking at a portfolio in Point Pleasant Beach that has its own private beach. Well, how can we create a beach club? Like that excites me. That like motivates me, like to create a beach club and maybe create like a beach spa, something like that. I'm like, okay, cool. I'll wake up excited to challenge that. The affordable housing, like for what it's worth, it is a very vanilla investment, and I need part of that for my portfolio. But it's the hospitality side that kind of gets my juices kind of flowing.
I can see that. I'm going to guess that you're the visionary of the operation, and then do you guys have like block and tackle partners that like keep their heads down and operate on that?
Yeah. So from a organizational kind of chart, what we have is we have the president of our property management company. He comes from property management side. He's managed over 500 units, 15 years of experience. Really no nonsense type of guy. Comes kind of like I label him like the street guy. Like the tenants are not going to get over him with like bullshit reasons, bullshit excuses. He oversees our localized managers. My main partner, Anthony Kahn from the affordable housing side, he's probably the most analytical guy possible. He's the guy who'll spot, he just actually reviewed the investor summary on our latest deck, and he's like, line 17 was missing a period. And I'm like, out of 56 slides, you caught that? Great.
Perfect.
Yeah, perfect. You are what we need you to be. And I was like joking around, like, do you want to change the shade of color in the font? But we work really, really well. On the hospitality side, I'm actually not the visionary. Like I partnered with the brand builder. He's more the visionary. He's the one that has really good. He lives in the shore. He has great connections in the shore. He comes up with a lot of these business plans, and it is my job to be like, all right, it can work, or maybe we could do it this way or that way. Like how can we do it, whatever it is. I actually kind of balance him out on that side, like how Anthony balances me out on the affordable housing side. And then we have more of an operational guy on the hospitality side to kind of round things out. So yeah, like high level, the only why it's kind of coming under the SIH brand is because all my other partners are strictly operators. So I am the guy who's like investing the time to do like investor relations and everything like that. They'll still bring in investors here and there, but I'm the guy who's really focused on bringing in the capital to do these deals.
Yeah, no, it's exciting to watch. We feel the same way, opportunistic, right? And if you can find the right operating partners and you just build different arms and go off of that, and it's interesting and fun what you can build with a little bit of hard work. It's been really informative. Dennis, what's before we let you go, we ask every guest, what's one book or podcast that you think everybody should listen, read, something that interests you right now? What's your go-to?
So I'll selfishly, I'll do a plug for the book I wrote, The Alternative Investment Almanac: Expert Insights on Building Personal Wealth in Non-Traditional Ways. I really wrote that book because there's just so many different alternative investments. So I didn't want to write 400 pages about mobile home parks and self-storages and all of that stuff. So the book is really like a 20-page synapse of the actual asset class. And then the reason why I do recommend the book is because it goes into 2 Q&As with 2 different investors, but it's the same questions asked to a self-storage guy, to a hard money guy, to a mobile home park guy, to a life insurance policy guy. And you see how their approach is different to the exact same question. So it's a really cool, like the multifamily guys I had in there were like 10,000 unit guys that had great track records. So you kind of see this different philosophies of all these different alternative investors. So it would probably be that book, which you can find on Amazon.
Well, I like the selfish plug, and we'll gladly give it to you. And you might as well follow it up with, where's the best place people can find you on the internet? They want to learn more about what you're doing.
Yeah, so the best place is our website, SIHcapitalgroup.com, capital with an A. We also have a YouTube channel where we do monthly webinars, and then we'll clip out stuff from the webinars. And you could just click learn more, or you could email me directly, Denis, DENIS, N with one N, Denis with one N, at SIHcapitalgroup.com.
Yeah, we'll get all that in the show notes so people can find you. Dude, we really appreciate it. As you can see, we went longer than we normally go because we were enjoying the conversation, because you're a real dude doing real stuff, because that's who and what we are. And guys, if you got any value out of this, Like I said, we don't care about the likes or subscribes. Share what Dennis was talking about. He was talking about some really powerful stuff, how to become an investor before you're even ready to quote unquote become an investor, how to find alternative investment assets. So, dude, it was a really fun show. We appreciate you, and we'll catch you guys on the next one.
Thanks.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.